Well, good morning, everybody. It's 10 o'clock, and we have a quorum. We'll call the meeting to order. Item 2 on the agenda is approve the minutes for the meeting of January 9th, 2014. Motion been made and seconded. All those in favor signify by aye. Opposed, same sign. Ayes have it. Item 3 is received 2 reports. Motion been made. Are there a second? All those in favor signify by aye. Opposed, same sign. Ayes have it. Item 4 is ratify approval of the payroll for the month and the action of the Secretary and Administrator to modify 6 applications. All those in favor signify by aye. Opposed, same sign. Ayes have it. Item 5 is approve the claims docket, and it's in your packet. Any questions on it? All those in favor signify by aye. Opposed, same sign. Ayes have it. Item 6, approve the following applications for service retirement. We have 1, 2, 3, 4, 5, 6, 7, 8. Motion been made. Are there a second? Second. All those in favor signify by aye. Opposed, same sign. Ayes have it. Item 7 is received reported death and authorized payment of $5,000 and authorized the Secretary to make the necessary change. Motion has been made. Are there a second? All those in favor signify by aye. Opposed, same sign. Ayes have it. Item 8 is receive reported death and authorize the Secretary to make the necessary changes to conform to the following. Motion been made. Are there a second? All those in favor signify by aye. Opposed, same sign. Ayes have it. Item 9 is receive a presentation by Kenneth Rowe. Is anybody from his family here? Nobody here. Do we need to go into executive session? Counselor? Okay. Then there's a disability under item C. There's to approve the following application for disability not in the line of duty for Kenneth Rowe. Motion been made. Are there a second? All those in favor signify by aye. Opposed, same sign. Ayes have it. Item 10 is, there's 2 items on here. The first one is item A, is a contract between the Employee Retirement System and the Independent Medical Examiner, and that's in your packet. Under A, we'll take them individually. Motion been made. Are there a second? All those in favor signify by aye. Opposed, same sign. Ayes have it. B is the litigation monitoring agreement between Grant and Eisenhofer professional attorneys to provide monitoring and security in corporate litigation services. Motion been made. Are there a second? All those in favor signify by aye. Opposed, same sign. Ayes have it. Item 11 is investment consultant report, and you're on, Jake.
Share the spotlight here with Andrew.
Okay.
We have, looks like a big pile of information for you this morning. We'll go through a couple of the things in detail, starting with the quarterly report for the period ending Q4 2013. We've also provided you with our 2013 year in review. We're not going to go through that, but for those of you that are interested, it's a pretty good piece just highlighting capital markets activity as well as economic activity for the year. The other 2 items that we have is a review, a little bit more detailed review of the private equity and real estate portfolios and a going forward plan to continue to implement that, as well as a discussion on further implementation of the real assets, specifically the commodities. So before we get to that, I'll let Andrew go through the quarter report.
All right, we go. Good morning, everybody. If we jump to the black book here, and in addition, we have the updated January numbers, which are in a smaller packet. So I'll reference those here in a minute. tab 1, if we can just jump to page 4. So big picture, really, despite several economic concerns in the year, really good year for stocks, ended up rising to record highs in the year. This is not including January, but just discussing the calendar year of 2013. On the flip side, though, fixed income assets really faced a difficult environment during the year. During the year, growth in the global economy was generally positive, especially in the United States and developed international countries. I think everybody is aware of the emerging markets. They've struggled throughout the year, as we've touched on in past months. From an economic point of view, growth in the U.S. in 2013 really driven by strong consumer demand throughout the year, and this just picked up as the year went on. Increases in housing prices, rising stock prices, improving labor market all led to a higher net worth for consumers. This led to more spending, confidence for spending. Employment gains steady during the year. Fourth quarter unemployment rate declined to 6.7%. So this averaged out to 7.4% unemployment rate for the year, which is the lowest in 5 years. On the international side, developed countries, they generally grew in the year as well as the debt crisis improved. Loose monetary policy in these countries, driven by the ECB's policies, similar to what happened in the United States, helped on that front. And then emerging markets declined during the year. Several issues there, really. A lot of EM countries are driven by commodities, especially those in Latin America. Commodity prices declined during the year. This hurt these countries. High account deficits in many large emerging market countries, Brazil, India, South Africa. These led to, high account deficits led to weakened currencies in many of these countries. And then finally, many countries tightened monetary policy to combat inflation. So when borrowing money becomes more expensive, growth generally slows down. So how did this impact market performance during the year? On page 5, we see the charts here. And we'll focus on the 1 year. Backing up, really, the year began with unease coming off of a 2012 calendar year, which saw above average market growth. The economy was and still is running on unprecedented monetary stimulus from the U.S., Europe, and Japan. On the U.S. front, the year began with a lot of uncertainty, increase in income taxes people were uncertain about, really a lot of debate surrounding government sequestration, but nonetheless the first quarter had strong performance equity-wise. Spring rolled around, a lot of speculation with the Fed beginning to taper the $85 billion in monthly asset purchases. This caused, throughout the spring, interest rates to go up, bond prices to decline, and equity prices took a hit mid-year as well. Then in the third quarter, U.S. stocks rallied again, and then the fourth quarter closed out with double-digit returns. So on the year, U.S. large-cap stocks had the best year since 1997, so really in a historic perspective, big year, up over 32%, S&P 500. Small-cap stocks, though, were a bigger story. They were up 40% in the year. So big year on the U.S. equity front. I just want to point out briefly on the 1 year chart here, these show on page 5 styles within the indices. You'll notice the orange bar here on the 1 year is the Russell 1000 value, and the dark green bar, Russell 1000 growth. Russell 1000 value up about 35%, Russell 2000 value up about 35%. Russell 2000 growth up about 43%. These are small cap stocks. Just wanted to point that out because there was a fairly large discrepancy in performance between Times Square and Earnest, Times Square being the growth manager there. On the non-U.S. front, stocks had a second consecutive strong year, up about 23%, and again in emerging markets, a rough year, down negative about 3%. So in addition to some of the short-term issues I just discussed, for U.S. investors in emerging markets, you had to translate these returns in these individual countries back to a stronger USD as EM currencies weakened. So this hurt U.S. investors significantly. So just to recap from best to worst on the equity front, U.S. small caps up about 40%, U.S. large caps up about 32%, non-U.S. developed countries up about 23%, and then emerging markets down about 2.6%. On the fixed income front, if we can turn ahead to page 10,
Just before that, back on page 4, because one of the things we're going to talk about is continuing to implement the asset allocation that was adopted in 2011, which included an increase to real assets from 5 to 15%, and also contemplated diversifying your real assets to include more opportunistic real estate as well as commodities. In addition to that, we also added the emerging markets and global bonds. So we've been somewhat deliberate in how the timing of implementing these things, really starting with the emerging markets and then the global bonds and commodities and the opportunistic real estate. That's going to be ongoing, much like private equity. The commodities has been something that we haven't been in a hurry to do, although we're going to talk about that today. It's intended to be a strategic allocation. It's not, we're not trying to time the markets, but that decision to be slow moving into commodities has actually been beneficial, as commodities over the last 3 years are down 8%, and in 2013 we're down 9%. That said, we're going to talk about going forward and fulfilling that mandate over the course of the year.
So back on the fixed income front, on page 10, again, just throughout the year, speculation increased that the Fed would taper asset purchases. Yields rose, bond prices declined. Yields and bond prices have an inverse relationship. And indeed, in December, just a few weeks ago, the Fed did announce that they would begin tapering asset purchases by about $10 billion a month. So as a result, U.S. 10-year Treasury yields started the year at about 1.76%. You can see the green line on this chart. That's the beginning of the year, and the purplish blue line at the top is the end of the year. So rates rose, yields finished the year, 10-year Treasury yields at 3.03%, bond prices declined, and as a result, the U.S. Barclays Aggregate Index, which measures U.S. investment-grade fixed income, declined about 2% on the year. So this was an area of the portfolio that struggled relative to equities, but equities more than made up for that. Flipping ahead to tab 2, we'll look at how this all impacted the portfolio. To page 16. This is just a quick snapshot of the total portfolio. You can see at the beginning of the year, the market value was $544 billion.
Million.
So that would be quite the
Your
case.
funded status would have taken a major improvement.
545. You had negative $5 million net additions to the portfolio, but investment performance on the year was very strong, adding nearly $91 million. So the year closed out at about $630 million. That's down to more about $619 million after a more sluggish January.
That net additions is contributions in, less benefit payments and other expenses out.
Flipping over to page 17. It's just a broad snapshot of performance, short-term and long-term performance of the portfolio. As you can see, in the first quarter, the portfolio advanced about 6%, and this contributed to a strong 16.5% increase in the year. Over 3 years, portfolio is in good shape, well ahead of the 7.5% required return, and in the top half of peers. Could move to page 19. This gives you a longer-term snapshot. This is over 12 years. You can see that the portfolio advanced about 6.4% annually over the last 12 years, about in line with the policy index, but a really important area to pay attention to is the risk metrics here. Standard deviation of 8.6 is significantly lower than the 9.5, and the Sharpe ratio, which essentially a higher Sharpe ratio means you're paid more for the amount of risk that you've taken, of 0.57 is above that of the policy index of 0.53. And then finally, before we get to the individual manager performance, the report card here on page 20. Over 5 years, the 7.5% actuarial required return has been exceeded substantially on an annual basis. But again, more importantly, I like to pay attention to the bottom, the last 3 points here, which really has to do with risk in the portfolio. Over 5 years, a standard deviation of 8.6% versus 10 of the index, and over 10 years, 8.6% versus about 9.45 of the index. We're just really happy right now with the risk position of the portfolio, just with a defensive mindset of the portfolio. Objectives are to meet obligations, not to hit home runs. So it is a strong position right now. And then the beta, which is the second to last bullet point, is the amount of market risk that is taken by the portfolio at about 0.84% over 5 years versus 1 of the benchmark, and then 0.89% over 10 years. So lower market risk than the overall markets.
So what, we mention this regularly, the portfolio is designed to participate in up markets, which you're doing. As Andrew mentioned, you have a 7.5% target return. That's the real goal over time with a prudent amount of risk. Your funded status is good at this point, so you don't need to try to hit home runs and just reach for return without being cognizant of that risk. So the portfolio is designed to participate in up markets, but not be down as much as the markets when markets go down, as we've seen happen. And when we look, we do compare to peers, but looking at peer group comparisons is more to say, help ask questions of, well, who's doing what? Why would other portfolios be looking better than ours, or why are other portfolios looking worse than ours? It's typically related to asset allocation, or it's always related to asset allocation. So as we look at that, relative to peers, when markets are going up, you're probably going to trail a little bit. And this portfolio tends to stay right about the median of peers, and you've got a lot of insurance built in. When markets go down, you tend to move up relative to peers. But more importantly, it's that required return of 7.5%, and over the last 5 years, you've outperformed that by about 4% per year.
Yeah, people tend to pay attention to the shiny performance numbers, but the risk metrics are certainly very, very important to pay attention to as well. Let's skip ahead to the handout. This is as of January. It seems a little bit more prudent to look at January performance. So we can see the portfolio about $619 million at the end of the month. Sort of sluggish month with equities, but fixed income kept up. So what's driven performance? Really much of it is explained by the bar charts here of asset allocation, and it's tied into what I discussed with capital market performance. You have about 40% of the portfolio in U.S. equities. So that explains a lot. U.S. equities had an extremely strong year, so this area of the portfolio participated very well and drove results. Flipping to page 2, this gives a little bit more of a concrete idea of what drove results. You can see under the U.S. large cap composite for the year, 22%. The small cap composite, and this is including a sluggish January again, up about 24%. So those are the main drivers of the portfolio. I did want to touch on the international managers and EMs have struggled. EMs really just because of the markets. The EM landscape has struggled, as I discussed, but the international managers also have a substantial amount of EM exposure, so that's caused them to lag slightly in this environment. And one other manager I did want to touch on was WAMCO, the fixed income manager. You may or may have not seen in the news recently there is an SEC fine levied on them. Relative to industry fines, it was a small one. It had to do with some cross-trading issues between client accounts that benefited some client accounts and did not benefit some client accounts. It was an unfair cross-trade. It did not influence this portfolio at all, but just wanted to make you aware for when you hear that or if you've seen that in the news. So no major concerns there. We're on top of it. They've made substantial amount of corrections with their coding within their system, so our concerns have sort of been quelled there.
It had to do with commingled funds that they managed, 2 separate commingled funds that they managed that had ERISA clients in them.
It was mostly corporate clients.
And there are ERISA rules with respect to self-dealing and putting one client over the other. So it wasn't like it was one pension fund over another pension fund. It was one of their commingled funds relative to another where they purchased securities from one fund from another fund, and they weren't doing it at the average price of the day, and so that technically violated some ERISA rules. They didn't. There was no findings of fault. They just entered into a settlement, and it was it was in the news and in the press, so something that we thought we should mention.
And one last point I just wanted to mention on the 1-month performance. A lot of people question, fixed income's role in portfolios, and you just have to look at a month like January to realize how important it is to keep that allocation of fixed income up to target weight, even though they values drop throughout the year. A month like January is a perfect demonstration of why it's a very important part of the portfolio.
Yeah, I think just in looking at that, so interest rates dropped from at the end of December, 10-year Treasury was at a little over 3%. It dropped down to about 1.6% in the month on economic weakness, expectations of slowing growth domestically, slowing growth in China, and just the need to have a bit of a correction. So if you think about the risk of fixed income, and many investors are like, what are we doing in fixed income? They expect the interest rates are going to go up. There's a lot of risk there. Well, 2013 was probably I don't want to say it's as bad as it could ever get, but it was bad for fixed income, down 2% on the ag. The month of January, the S&P was down 3.5% in 1 month. So the relative risk between fixed income and stocks, there's a huge difference. So moving out of fixed income just because we're concerned about, to say I want to move out of fixed income or lower my fixed income because I'm concerned about interest rate risk and move into stocks, yeah, you're maybe getting rid of some of the interest rate risk, but you're adding significantly more portfolio risk to the portfolio. So that's why, as difficult as it is to rebalance, and that exercise is moving from things that are doing well into things that aren't doing well, it's because of the risk profile and risk posture that you've established as a board for the long term is why you do that. If you will, now if you just turn back to the asset allocation page on the front of the monthly ASAP, and you'll see looking at the targets in the targets versus actual and the over-underweights. Large cap is about 6% overweight. If we go down, total equity is 5% overweight. Within equity, large cap and small cap are overweight, and private equity is underweight. That private equity underweight is because that's you're investing in closed-end funds that call down capital over time. It's going to require making continued commitments as this portfolio grows. Money will start coming back. As you make new commitments, you'll start putting more money in. That underweight to private equity is really in large cap right now. If we look at the fixed income is also overweight relative to targets, and that's because the target, what really changed in 2011, while you made some tweaks within equity and within fixed income from an asset allocation standpoint, we didn't change the overall target to equity or fixed income, actually brought fixed income down by 5% from its previous target. And that 5% was added to real assets and also brought, we brought fixed income down by 10% from 35% target to 25% target. That 10% was added to real assets. So then within real assets, we made a target of 5% or 6% to core real estate, which is the Morgan Stanley Prime Property Fund, 4% to opportunistic real estate, which is going to be more of these closed-end type of real estate funds that call down capital over time, invest in properties that need some fixing up. More of the return will come from market appreciation as opposed to income, which is the return in the core space. And then the other piece, the other 5%, is to commodities. So if you will, we have two pieces that I just wanted to quickly go through on these portions of the portfolio that aren't up to targets yet, and just talking about the go-forward program to start to move the portfolio toward these targets. I'm going to start with this book, Private Equity and Real Estate Program Update. Unlike the commodities piece, what we're talking about here, these are illiquid strategies. So we really refer to these allocations within your portfolio as programs. You'll hear us talking about the private equity program and the private real estate program. If you turn to just go to tab 2, page 13, I have a summary of what's happened within your private equity program to date. And I think this is a good visual to understand. There's a lot of different metrics here. The light blue bars, those are cumulative contribution. So as you may recall, when you select a private equity fund, you're actually making what's called a commitment, which is essentially a promise to fund that manager over time. Depending on the nature of the fund, they're going to call down that commitment in contributions to them over generally a 3 to 5 year period. With fund of funds, that period is a little bit extended. It's more like a 5 to 7 year period. So what you can see here is the inception. Your first commitment was in 2009. About $4 million in capital was contributed that year. It's gotten up as of the end of 2013, close to $16 million in contributions. The yellow bar, if you will, or yellow line, that's a carrying value or market value. So in terms of asset allocation, that's what we're looking at to say what percentage of your portfolio is currently invested in private equity. And it doesn't tie directly. It's growing over time, and you can see really in that mid-2011 period, you started to see some appreciation over that bar. The yellow bar was up over your contributions. But then there's this green line, which is distributions. That's money coming back to you. So unlike your traditional managers, when there's gains in the portfolio or dividends or interest, that money is reinvested. In private equity and private real estate, that money is sent back to you. So it requires constant refeeding of the program, if you will, to get it up to targets. From next page just shows the actual investments, and this is in your report as well. You have 3 current investments in the private equity program. The first 2, as we started out to get you broad exposure across private markets with 2 fund of funds. Mesirow Private Equity Fund 5. This is a diversified fund of funds that's investing in a number of 20 to 30 underlying partnerships, private equity partnerships that then ultimately invest in portfolio companies across the business cycle, from early stage venture to distressed, turnaround, management buyout. Singular Guff is more focused, it's more of a niche fund of funds, although it's investing in multiple managers. It was taking advantage of the opportunity that was available after 2008 to buy distressed companies or distressed securities in a diversified way. And then finally, your most recent commitment in 2012 to Warburg Pincus, that was your first direct private equity fund, so an individual manager. Warburg Pincus is a global manager. Its strategy is they'll do both growth capital, early stage venture, as well as management buyout and turnarounds. It's very diversified, but it's a direct strategy. Going forward, we think, based on your size and the dollars that you have available to commit, you have the ability to look at single investment managers, direct strategies. And that will help, give you a little bit more bang for your buck with private equity and reduce the cost of investing. There's a pretty big dispersion, and this doesn't show it that well, but we're showing all of these investments are in the very early stages. None of them are what we would consider to be mature private equity investments. But you can see, looking at the Mesirow fund, the gross IRR, or rate of return that to the fund, has been 21%. The net to you has been about an 8.3% annualized. We expect that net will go up over time, and the gap will narrow a little bit, but it won't narrow as much as it will for instance, in the Warburg Pincus. That's a big gap right now in a direct fund. That's earlier on in that fund. You're only about a year into that fund. The fees, you're paying fees on committed dollars. So you're paying fees on the total amount you've promised to pay them. So early on, that's a big drag on returns. That's the J curve that you see. But over time, in direct funds, we'll be able to mitigate some of that drag from expenses, and I think you're of the size where you're able to do that. So that's why when we did Warburg Pincus, we're doing a direct fund, and we think that it makes sense to continue down that path going forward. The next page just looks at the results relative to market benchmarks. That 9.7% on 5 years, it's a little short of 5 years. It's 4 years and 11 months since the initial investment. We'd expect to see this lagging public market benchmarks for two reasons. One, public equities are up significantly over that 5-year period. Private markets tend to lag. More importantly is the maturity of your private equity program. It's very young. Excuse me. The investments that you're making in 2009 and 10, 11, 12, those have not matured to where these companies have gone public. Typically, there's a 7-year harvest period, 5 to 7 year harvest period before you start to see the benefit of those investments early on. So we think it's tracking along as it should. This last page within this section is really what's important for today, the takeaway. With private equity, because you can't decide when to put money in or take money out, the way we try to go about determining how much money or capital you need to commit on an annual basis is through an annual commitment analysis, if you will. So we've developed this cash flow model to work with clients to say, you have a 5% target in private equity. We know we can't get there today. How much money do we need to commit on a yearly basis to get to that target and maintain that target in a reasonable period of time? So what we're showing here, if you go down to the middle of the page in that blue line, your portfolio value, this is using essentially your 1231 values, a little over 630 million, 2.5. Your private equity portfolio weight is 2.5%. That's actual. That's what it is at the end of the year. We make assumptions based on the types of funds you're in as to what the cash flows will look like going forward. Again, these are estimates based on how we understand these vehicles to work, making reasonable return assumptions, certainly not making unreasonable return assumptions like you're going to get a 10x multiple. These should be like a 1.5 to 2 multiple depending on the type of investment you're in. But what this is showing is that if we make commitments, and this is up on top, in 2014 by year, new commitments of $7.5 million a year, and we just go out 5 years, that you should reach 5% target in 2017. So really what we're trying to do here is come up with a budget, if you will. This is going to change, but we need to have at least a 12 to 18-month outlook on this commitment amount so we can identify, okay, it's reasonable to make commitments of $7.5 million in private equity over the next year, do another $7.5 million next year. We'll look at this again in a year. And what could change? Well, if the markets do poorly, if the markets do poorly, long-only markets, and your portfolio value goes down, more than likely your private equity will become a larger piece of your portfolio because the valuations are going to lag. And so we don't want to put too much money to work. We also don't want to put too little to work. So this amount of $7.5 million per year right now seems like a reasonable amount. Not making any recommendations. This is just a plan at this time. We have several things that are in the pipeline within the corporate finance and distressed areas that we would anticipate coming back to you with sometime this year. Nothing right now. The purpose of this is just to kind of show you what the dollar amount looks like with what we'd be targeting. Any questions on that?
Yes, Jason, a question. Is it common to pay a fee on the committed amount even if it's not used, or is that particularly the Walberg Peak?
No, that's how private equity funds are operated. Because if the work is done on finding the investments, so they're paid. The fee actually in private equity funds is graduated over time. So during the commitment period, you are paying a basis points fee on the committed amount, and then over time that will go to the invested amount, and it actually, the percentage in many funds actually comes down over time.
I've got a question in terms of the allocations. What's the commitment in time as it relates to any penalties if you choose to change directions? In other words, pull out of a private equity fund?
Well, once you're in, you have no ability you have, I don't want to say none, you have limited ability to get out.
Right.
So they're illiquid investments, and that's why we want to be very careful as to how much we put to work, looking at the overall portfolio, making sure that, you know, we have a 5% target. We don't want to get to 20% because we overcommit. And you saw that happen to a lot of funds, much larger funds, in the late 90s, because they like the returns of venture so much that you put out huge commitments. That money's called down, and then equity markets, the technology bubble burst. Equity markets were down 30%, and now all of a sudden you've got 20% of your portfolio that's illiquid, and you can't get out of it. You can't get out of it easily. You can sell. There is a secondary market where there's significant discounts, but once we've made this allocation, we need to be committed to it, but we need to be prudent about how we put it to work. I think that's how it's managed.
Jason, the things that you're looking at now that you're thinking about bringing to us later, are those fund managers, or are those going to be more direct managers?
Our feeling is that you have the ability to do directs at this dollar amount. You'll still have, I mean, there's still a lot of capital to be called down by these fund-to-funds, so you'll have pretty significant diversification. But over time, at $600 million, and as you grow, hopefully the portfolio grows, 5%, putting a little bit out each year, we look to have maybe 5 to 10 different relationships within this private equity program, and you're going to recommitting as they come back to market. I think you can still get pretty good diversification. The other thing is, from private equity, we're looking at it as a return enhancer. So watering it down too much with a lot of diversification isn't necessarily beneficial to you. You've got a lot of insurance in other places in the portfolio, having 15% and long short, and having conservative managers in other places. So we think our recommendation would be to move toward more direct exposure.
I'm really not trying to get ahead of it too far, but so if things kind of play out the way you're talking about, would we be looking at picking one direct manager for $7.5 million, or would we be looking at picking 2 or 3?
No, what this plan would contemplate is really one in 2014, another one, different one in 2015, another one in 2016, although those numbers may change. So if your portfolio grows by 20%, 7.5 may become 10, and then it might make sense to do 2 at 5. But right now, what this is really looking at is one commitment per year to a single manager. It's just moving to the real estate side. It's a similar discussion, a little bit different because the core real estate is a bit more liquid. So on page 19, just from a risk return standpoint, we try to lay this out, what you have today. So when we talk in terms of real estate, we could break it down much further, but just to be fairly general, there's core, value add, and opportunistic. Core real estate is typically focused on fully leased, multi-tenant properties in high-quality urban business centers. That's your Morgan Stanley Prime Property Fund investment. We would expect over time that 85 to 95% of the return is coming from income that is being produced by the portfolio as opposed to price appreciation or expansion. Value add, this is a little bit further out on the risk curve in terms of real estate. Value add and opportunistic strategies are more often than not, you can only access them via closed-end private equity, more illiquid type strategies. And the reason for that is that they require a little bit more patience. If you had investors that were able to get in and get out, that might disrupt the strategy a little bit more. They're using a little bit more leverage, requires some improvement, maybe even redevelopment, to get a little bit more return. So return expectations there, if we think of core as 7 to 9%, value add is more 9 to 11, and opportunistic a little bit more than that, but with the additional risk as well. So from an asset allocation standpoint, you have a target of 4% to value add real estate. Right now, you're at 0.3%. You've made one commitment to TA. That commitment was done just this in 2013, I believe. Late 2012, fourth quarter 2012, for $5 million. They've drawn 1.75, and there's 3.25 million left there. So similar, we want to be able to build this portfolio out. Page 23, we show a chart on the inception to date cash flows. This looks a little bit different than the private equity, and that's because your initial investment in the Morgan Stanley Prime Property Fund is in a core open-end fund where they did take down the capital all at once. So a little bit different structure. So you got to where you wanted to be a little bit sooner, a little bit early in terms of market cycle, and you saw a dip in NAV, which has recovered since that time. Going forward, page 25, a similar cash flow model, trying to get the core, or the overall real estate core plus value add and opportunistic up to 10%. Really what we're looking at here is the value add opportunistic piece. You're at 6% in core. It's how do we get that 4% value add opportunistic up to target. And the numbers here are a little bit more modest, $5 million a year. Pace would get you to 10% in 2018. You might say, well, that's fairly conservative, but the reason for it is because of your question. If we don't want to be too aggressive in getting there, because we've seen what can happen if you do. Not that either of these allocations, 5% to private equity and 4% to opportunistic value-add real estate, is not going to create liquidity problems for this system. You've got a lot of liquidity. You have a long-term time horizon. Those are certainly reasonable amounts, but we do want to be cognizant of that. So on the real estate side, looking at a budget, if you will, for value-add opportunistic real estate of 5 million commitments per year. I have a little bit more detail here on page 26. I think what we'd be looking for here, similar pipelines sometime before the end of the year. We've got a number of things that we're looking at, preferably looking at direct funds, again, that are diversified, probably more of a global player right now. The TA, in terms of the risk spectrum of value added, is pretty conservative. So maybe looking at managers that are more focused in a little bit more opportunistic or distressed, taking advantage of some other dislocations in the real estate market. Again, no takeaway other than just wanted to show you what the plan is and that we'll be coming back later in the year. Any questions on that? Okay. Finally, I'm going to continue talking about the real assets, if you will. So the commodities allocation, in 2011, you redid the asset allocation, reduced fixed income overall by 10%, and that reduction of fixed income from 35 to 25 really went to real assets, the target allocation, taking real assets from 5 to 15. Your real assets also, within that, we diversified how the allocation was to look over time. So 6% to core, 4% to value add, and 5% to commodities. Within the fixed income, even though it was brought down from 35 to 25, there was diversification within that. We overweighted active relative to passive, and we added a target to global bonds of 7.5%, which is the Brandywine piece. And then on the equity side, the allocation didn't change. The overall target to equity stayed at 65%, but the mix within that changed a little bit, and that was really taking some from large cap and adding emerging markets. From an implementation standpoint, it's taken really the course of the last 2 years to get to where you are today, which is we added the global fixed income, we added 2 emerging market managers, more larger cap in Von Tobel and the small cap in Wasatch, and you began to build out the opportunistic real estate portfolio with TA. Commodities, we've been slow to do that. It hasn't, because there's been other things to do. It's been a benefit. Again, we weren't trying to be tactical, but we were mindful of what was happening. Overall, the allocation to commodities is intended to be a strategic allocation to provide diversification benefits. And just want to give you just some brief review of what we talked about back in 2011. Review for some, it might be new to others. But what we're talking about is commodities are tangible goods. Could be a variety of things. There's petroleum or energy-related commodities, agriculture, livestock, metals is broadly speaking what the commodities market is. From an investment standpoint, you typically invest in these through not buying the hard asset, but accessing them through managers that are buying futures or options on the underlying commodity. Commodities tend to be highest at the end of economic expansion and lowest at the end of a contraction. Going forward, there continues to be strong demand for commodities driven both by emerging and developed economies, and a lot of needs for infrastructure development in developing economies support this demand trend. We know commodities allocations are going to be highly volatile. I'm just going to skip forward a couple pages. As we've seen in the last couple years, the correlation between commodities and other asset classes is one of the major benefits. They have very low correlation, so they provide significant diversification benefits and also protection in an inflationary environment. Page 6, we just tried to show commodity benefits, the portfolio diversification benefits relative to stocks. And this is showing from January of 1991 through December of 2013, in declining periods where the S&P 500 declined, what the return of the Dow Jones Commodities Index was. So with the exception of the period April through September of 2011, where stocks were down 16%, commodities were down 20%. There's a 3.8% differential. And then the March of 2012 through May of 2012, commodities did underperform. But in all the other periods where stocks were down, commodities were up, indicating some diversification benefits. Similar, on average, it's about 400 basis points. Similar for fixed income. You can see in periods where stocks were down, with the exception of 2008, during the recession, where there's a huge decline in commodity prices as demand just went to zero. Commodities have provided diversification benefits as well. So basically, the case for this, and as we did the asset allocation, what you'll see in a strategic asset allocation and over a long term, the addition of commodities isn't necessarily moving the return dial significantly. It's actually, despite the volatility or the price volatility of commodities, it actually reduces portfolio risk because they don't behave like other asset classes. The risk and the volatility is controlled through the asset allocation. It's a limited dollar amount, 5%, but we do believe it provides significant correlation benefits, downside protection in both declining equity and fixed income markets, and strong performance in inflationary environments, which over the long term we do expect to see inflation, not necessarily in the near term. But we do this, we're not changing, we're not recommending changing the asset allocation, but just because commodities have been down for 2 years, we think it's important to remind you what we're trying to move toward. we also don't want to be in the position, and some clients may say, well, when should we do this? Well, we don't know when things are going to turn. This is a strategic allocation. I showed commodities have been down for 2 years. We've been lucky. I mean, we were thoughtful in not implementing it, but we think we do need to move forward. So much like the private equity and the opportunistic real estate, there's no takeaway today, although we will come back a little bit sooner. I think our goal would be to come back in April with candidate commodity managers to present to you, and then have you interview managers in May for potential consideration for this 5% allocation. We would expect this to be a single manager for this 5%. This is a highly liquid market. You get in and get out, unlike the private equity and real estate. So I know it took a lot of time, but just wanted to give an update on where we were and just kind of put together a plan moving forward for the board's education.
Any questions of Jake about that? Or
Just
Andrew?
quickly, just depending on future agendas, we were going to discuss bringing in managers as well. It's been a while.
We haven't had, there's been a few managers haven't been in some time, and depending on the schedule, I think you had your real estate manager, or not real estate, your international managers have essentially all been in because they're all new within the last 12 months. The WAMCO, it's been a little bit since they've been in. Your two hedge fund managers, PAMCO and K2, it's been a while. So depending on schedule, I don't know if we want to put a plan together for the balance of the year to have in, I'd say, Western, and then your two hedge fund managers and your two small cap managers at meetings
Okay,
throughout the balance of the year.
all right.
We'll just plan that.
Get with Renee and we'll settle how we're going to do that.
Okay.
Any board members have any questions about what he's discussed? All right, nothing else. Thank you, sir.
Thank you.
Item 12, comments from board, staff, or citizens. The only thing I have, Renee, would you tell us again what the cost of living was percent for?
Yes, the CPI was released on January 16th, and it was 1.5%. The 1.5% was provided to all eligible retirees on their January checks.
Okay, thank you. Any other questions? NCEPR's conference is coming up in Chicago in May. I think that's...
April 27th.
Is it April 27th?
Is the start, yes.
Okay.
We haven't got the agendas yet. We just got, because they had a change in dates and times and locations due to some other, it was originally scheduled for San Antonio, but we haven't got the agendas yet. So as soon as we have those, we'll get those out. I hope to have it on next month's agenda for approval to send it to
Okay.
Keith.
Anything else anybody has?
The retiree meeting for Tuesday was postponed due to the weather. However, I did have some phone calls that asked me to express the appreciation of the retirees to the board and to Renee for the 1.5 that came through like a champion, and we didn't have to refigure and so forth. So, and also our sympathies for the, what was it, a little water problem over there at 420 West Main?
Yes, the basement of the 420 West Main was flooded. We were shut down Monday through Wednesday of last week. We have partial, we're running on generators right now in the building. Paul can probably give you a better update than that. We currently have some personnel from the personnel department in our offices providing them temporary office space. Temporary office space may be anywhere from today to 2 or 3 years, depending on how long it takes them to get moved around and where they end up. But right now we are providing locations for some of their office staff here. They have other staff spread out throughout the city locations.
Thank you. Anything else? Anything else? If not, we're adjourned at 10:54. Thank you all.